Today we are talking about the 3 simple steps to start your hard money lending business and to take it from 0 to 10 million in the portfolio inside of 3 years. How do we know that's the right target? Because my business partner Jason and I did exactly that when we started Hard Money Bankers. And once our business partners came on to expand geographically, they were also able to grow from 0 to 10 million in their market in between 2 and 3 years. And since then, a number of members of our Mastermind group have done the exact same, 0 to 10 million inside of 3 years. During this video, if you're curious about working with us directly, click on the link below to book a call and to talk to our team. All right, let's dive in. Backing up a little bit, my business partner Jason and I started Hard Money Bankers in the end of 2007, which was right in the middle of the Great Recession, which is a crazy time to start a lending business. But here's why we did it. Before that, we were in the mortgage business and we had dabbled in some real estate investing. We had done some flips, we had done some wholesales, and we borrowed from a hard money lender out of Texas. We were doing a flip in New Jersey at the time. And during that, it was a lot of work doing these flips that this guy funded. And we made some money. It worked out okay. But once we looked at the numbers at the end, that lender made about the same amount as we did, only we did a ton of work. And he did almost nothing besides underwrite and fund the loan at the beginning and then collect the payments. So since we had a lending background and we knew enough about real estate investing, we were like, all right, let's go into that model. That's the business. That's the best equation of work in to money out that we've seen across real estate. That's why it's our favorite model, has been for a long time. The only problem was when we were starting, we didn't have any capital. We didn't have rich families. We didn't have people that we could call and be like, hey, I need several million bucks to lend out. We were 27, we didn't have much of a track record, and like I said, there's a foreclosure boom going on. The financial world had just crashed. Point being, if we were able to start and raise capital at that time, you can definitely do it now. Now's the time. There's a ton of capital looking to get into this space, and we're gonna break down the 3 steps to starting the business, which is capital, deals, and team right now. Let's start with capital. Okay, so like I mentioned before, we didn't have people who we could just pick up the phone and call, and that's what we call our first degree network. Somebody that you know personally that you can reach out and contact. So that one's kind of out. But we did find that in our second degree network, there was all the capital that we are gonna need. What does that mean? All the people that we know, all the people that they know, right? So I started by spreadsheeting these people and making calls, and there's a good amount of work to it. But that's heavy lifting at the front. That doesn't go on forever. Like once you raise capital, it stays with you for a long time. Let's also talk about the common personality types that go along with the right kind of investors. In case you aren't familiar, DISC personality profile is a very, very useful thing. I recommend looking into it if you're not familiar with it already. And we focus on the D and the S, and we try to stay away from the I and the C. Let's break those down quickly. So the D is the dominant personality, right? Your type A businessman or woman. The S is more of the passive, maybe a self-directed IRA investor or a relative or someone who's older and retired. Like they tend to be much more passive. I and C. I is the influencer. They tend to be the life of the party, the salesperson. We've found that that's not the best target for raising capital because there might not be a whole lot of capital behind that personality. And then the C, conscientious, is your super analytical. They're very tough to deal with. They honestly are because they can underwrite themselves even out of the best deals. So, of course, you can't give investors a personality profile, so you kind of have to get used to determining what people are just in conversation and by knowing them and getting to know them. Common professions. So across our investor base, I can definitely say that some of the common professions under the D personality type is business owner, people in finance, people in real estate, maybe even accountants, but that can cross over into C a little bit. And on the S, that's typically people who could be retired, maybe they're self-directed IRA investors, stuff like that, right? So, an important part about initially approaching capital investors. One, I would try to get an in-person meeting if at all possible, but you know, successful people are busy, so sometimes that's not always easy to do. Phone works too. Zoom is a tool that we didn't have back in the day, but that's a very useful one now. So I would definitely make good use of that tool and present a simple pitch deck, right? You don't want something with a ton of reading. Busy people aren't going to read that. You want it to be maybe 5, 7 pages long, graphics, some big letters, and try to go through your pitch deck, which basically shows, here's the type of lending we're doing, here's our geographic market, here's why it makes sense, here's your rate of return, a little background on us, the founders, and here's some sampled deals. Typical deals are important. Here's why. When you're first approaching investors, you don't want to give them an absolute home run. You don't want to give them a 20 LTV no-brainer deal. And of course, on the other side, you don't want to show them any kind of bad deal. That's not the plan. You want to show them a bread and butter deal. Here's what we do day in and day out, and get them comfortable with your bread and butter. Because if they're going to be in this game, they're going to need to be comfortable with that, right? Here's an important part. The 30 to 60-day scripting. Let them know that you are fully funded. That could be because you have a good amount of capital, or maybe you don't, but you only have one deal, and that one deal is funded, right? So let them know that we are fully funded at the moment, but we could have some more availability in the next 30 to 60 days, and I'll get back to you at that time. And during that time, you're going to put them in your email list for capital investors only and drip out emails to them, right? So that you're pinging them every week with little, not a pitch, just with little wins that are happening at your company. We closed this loan. Here's a before and after on a rehab job. This one paid off. We just paid X amount to a capital investor, so that they can see during that process that other people are invested in your deals, they're getting paid, and they should get in the game too. So that when you do reach out to them, right, 30 or 60 days later, that they're already going to be primed to say yes. They've seen what's going on. They want what you have to offer. So you reach out, you go through, here's a deal, we have closing next week, go through the basics on them. You're really only gonna have to do this with them on the first deal, then after that they'll know how to go through the file on their own. Go through the deal, bread and butter deal, 65 LTV, DC metro area, 200K loan amount, all the normal stuff. And a lot of people will try to say no to the first deal. A D personality type is gonna try to say no to the first deal because they're trying to take control of the situation. They're trying to tell you that I'm going to pick and choose what I do and don't do with you, but you can't allow that because they need to know that any deal you put in front of them is getting funded. If it's not by them, it's by another investor, right? So the scripting around that is, this is a very bread and butter deal. All of our other deals are going to look like this too. The one that, if you say no to this one, the one that I will send next week is going to be very similar to this. So if this type of loan isn't something you're looking to invest in, maybe this is not the right kind of investment for you, frankly. Not being rude or anything like that, it's just a case, right? And that should lead to very close to 100% closing percentage when you follow this process. Okay, talk about rate of return real quick. So in our business, it's very common to charge $12.99 to the borrower and to pay 10% to the investor. Very close to an 80-20 split. So you're getting 20% of every dollar that comes in the door. It's a pretty nice take once you build up a decent sized loan portfolio. Later on, I put system here. You don't have to do this right away. Later on, you're going to want a proper loan servicing software because that makes life really easy for you and it starts raising capital for you. How does it do that? In our system, we pay out weekly. Whatever has come in the past week in terms of interest, from monthly payments, from per diem, from a new closing, we're pinging them electronically by ACH every week with whatever interest has come in. At the same time, they get a statement sent to their email saying, here's how much we just paid you. And this starts raising capital for you. They can easily reach out and be like, oh, this is going great. Can I give you another 500K, right? Whereas if you were sending checks, there's a disconnect. A check goes in the mail once a month, it goes out, they get it, they deposit it, great. But it's not the same kind of ability to respond that this whole email and everything else system does have. Real quick, if you haven't done so, feel free to click below, book a time to speak to our team, talk to Dave Bauer, our program manager. He'll walk you through everything we're up to. All right, moving on. Let's talk about deals. Deals, this is where the money's made, right? So for the purpose of this illustration, we're going to talk about an average loan amount of $200K. And if we're getting to a $10 million portfolio inside of 2 or 3 years, then you're looking at 50 loans, right? In a $200K loan amount, since we charge 3 points at closing, $6,000 in origination fee, we charge a $995 funding fee, which is very common in the industry for the purpose of this illustration. We'll just go $7,000 at the time of closing. Plus, remember, you're going to be getting 20% of every payment that comes in the door. So on this, if we just use 12%, again, just to use round numbers and keep this easy, their monthly payment is going to be $2,000. You get 20% of that. So you're getting $400 every time they make a payment. Just think if you had a bunch of loans outstanding, right? Plus your origination fee of $7,000. And this is why we use the average profit calculation for any deal you do. Let's use $10,000. In reality, it's a bit more. In reality, our average loan amount is a bit higher than that. But let's use $10,000 because that's useful for marketing calculations, everything else. Let's talk about how to get deals. Now, I put here free first and paid later. So what I mean by that is, let's do free marketing stuff first before we start putting budget towards ad spend and everything else. Online and offline free stuff. One, I would definitely hit local meetup groups. There are lots of real estate investors in every meeting in your area. Check out meetup.com. You'll probably find 5 or 7 of them. And start talking to investors, start talking to rehabbers. See what they are looking for in terms of financing, see what they're getting now, create some relationships, make sure to grab that contact information so they can go into your database too. And then you're gonna be following up with them. That's the online stuff that's also free. Pull together all of the contact information that you have from anybody you know in business, hopefully specifically in real estate. Could be real estate agents, real estate investors, title companies, appraisers, mortgage lenders. Put them into an email database and ping them once a week again with, here's what's going on at our company. Just closed a deal, before and after, all that stuff, right? Later on, you can do paid traffic to get more. This is a very easy business to run paid traffic in. Why? Because our minimum sales, $10,000 profit. You can get $100 loan applications and get 100 of them and spend $10,000 to close one deal. Of course, it's going to be much higher than that. You're going to close a lot more. If you get 100 loan applications, you're going to close a lot of them. But that's why it makes sense. This is a built-in high ticket sale with that $10,000 bottom line for every deal that we do. Here's another great part about it. Repeat clients. Think about regular mortgage lending, for example. Somebody buys a house, they get a mortgage from a lender, and they probably don't need another mortgage loan for 5, 7, 8 years, something like that. Maybe they'll refinance at some point down the road, maybe they'll sell and move somewhere else, but they don't need mortgage loans all the time. Real estate investors who are flippers, they're going to be able to borrow from you several times a year. And so even if you have a cost of acquisition like paid traffic, you're going to be getting this minimum $10,000 every time they do another deal. And then you get a few dozen of these flippers in your portfolio, and we're talking a ton of repeat business. It turns into a database game, right? So you have all this contact information over time from all these investors that you've met. You're going to be pinging them weekly on email. You can also do some phone stuff, voice broadcasts, an occasional text message. You got to do it compliant, everything else, but make sure to get email addresses and phone numbers so that you can stay in front of these people. It's going to be turning into repeat $10,000 clients over and over and over. Okay, cool. Let's talk about the team, because the reality is this is set up to be a lifestyle business. That calculation I was talking about before with the work that goes into it and the money that comes out is the best in private lending. It really is. And so the lifestyle business requires a couple people on the team. Not a lot of overhead, but over time to get to that 10 million, you're gonna need a little help. Not at first though. First things first, you're gonna need an attorney to do your loan documents. We do not recommend in our system that lenders do their own loan documents. In addition to that, they're gonna be doing a title review and negotiating title insurance on your behalf. So you're gonna want an attorney that focuses on commercial real estate loan documents. Even though we're doing residential properties, it's a commercial loan. So that's the kind of attorney I would look for. I put inspector here with a question mark because at first, it's gonna make sense to do some of your own inspections. Again, not all the time and not forever. We don't do them anymore, but we did when we started because we wanted to, A, put our eyes on the property, get to know construction, everything else, and also it's just more touch points with your clients, more times that you can see them. Later on, you can hire inspectors, but at first, I would do some of that heavy lifting. Again, it's not gonna be forever. Most people wanna get a bookkeeper pretty much as soon as possible. Like a lot of lenders don't wanna do their own books, and then later on, when you get the system, the software I was talking about, they'll be able to run that, do all the keystrokes in that so that you don't have to. Later on, after that, once you're getting up to 50 loans outstanding, you're gonna want a process or two to prepare your files for closing and also to process construction draws, because that tends to be, especially prepping for closing, tends to be a bit cumbersome once you're doing several loans a month. Now, some people can combine these into two. That may or may not be a good idea because they tend to be different personality types for the most part. The processor's more client-facing, more front-facing for your borrowers, and bookkeepers and their personality type tend to not want to do that, but you might be able to blend that into one if you find the right person. All right, everyone, so that was the full system laid out. The 3 steps are capital, deals, and team so that you can grow your company from 0 to a $10 million loan portfolio in 2 to 3 years and keep it a lifestyle business. Thanks for watching, guys. And if you haven't done so already, click below, schedule a time to talk to our team, and work with us directly.